Hey, welcome back to the show, Total Financial Solutions, Safer Money Hour. I'm Arif Halaby with Jeff Gerard and, of course, our special guest. We're talking about, what does it take when it comes to P&C, property and casualty, the part of your insurance, I've heard you guys discussing as we went before, and John, part of the challenge is that for so many people in the auto insurance world, it is such a bittersweet thing, right? We hate it until we need it, and then we're grateful, but you're stuck in this little circle. Mm-hmm. So tell me, what does it take when we are trying to build, and it's time to make a change? How do I know I should shop around? Because you're going to hear this. Oh, my dad had this guy, and then my grandmother and my cousin, and they've insured 18 of our vehicles.
Correct.
When does the change come?
So in a perfect world, you would like to make that change on your renewal date. Generally, though, we have people change policies at all different times. The renewal date is the most favorable just because it's the beginning and ending. It's the ending of a contract and beginning of the next contract that they've offered. If you were to cancel in the middle of your policy, you could do that. They'll refund you on a prorated basis.
So let's explain what that means. That means whatever the unused payment amount is.
That's correct.
You get that back.
So say your policy was January 1st to January 1st and you canceled it on June 1st, you would get a 6-month refund of or whatever amount that you've paid days of insurance that you haven't used. So they actually do it by the day.
Okay. So you got the days of insurance, you get a refund. Even if you've already paid it a year ago or 6 months ago, you're going to get that portion back.
Correct.
And then, but sometimes there's a cancellation
Sometimes
fee.
there's a cancellation penalty, and it's carrier dependent, and that fee depends on A, the carrier's cancellation procedure, and B, where you're at in that policy contract compared to when it renews. So the perfect answer to your question is when it renews is obviously the most favorable because it's the ending of a contract. You can exit it without a penalty at any time. But what we do, because it's not always a perfect world, is we'll try to time that cancellation with when you would normally make your next payment.
Yeah.
So that your payment is to the new carrier versus the old carrier. Cancel with the old carrier, and then they send you a final, like a reconciliation, either bill or refund. Because sometimes people will cancel and they'll owe the other carrier a little bit of money based on what day they canceled versus when they were paid through.
So you had a question, Jeff, that was fascinating to me because both of us have a combination of, well, at least at one point, 8 of these things happening.
That's right. So, John, for those of us that have teenage children,
that's 8 of them,
myself included,
all of us here at the table, how do we go about that? And is it something that we should just expect to just really have to come out of pocket with?
It's come out of pocket with in terms of the increase.
Yes.
There's definitely a substantial increase when you have what they call a youthful driver. A youthful driver being someone in their first 3 years of driving experience.
Not somebody that just got Botox.
Correct. Not somebody that just got Botox.
That can look pretty good.
They would look youthful, but not truly be youthful.
Okay.
Bottom line, it's more expensive. The best way, in my opinion, and it's difficult to do, but the most cost-effective way from an insurance standpoint is to purchase a vehicle that you can afford to pay for, that you can justify covering with what they call liability-only coverage. So insurance has 2 components. Liability, that's for people and things that you hit. You rear-end someone, you injure them, it pays their injuries, it pays their property damage. And then there's comp and collision, which is the second component of what consumers would consider full coverage.
So that's what hits you.
That's your vehicle. That's your vehicle. So if you're
is that whether your fault or their fault, it doesn't matter?
Well, if they're at fault, their policy, assuming they have coverage and it's active and their carrier will accept liability, their policy will actually pay for the damage to your vehicle. But the proper way to make sure that risk is mitigated is to actually purchase comp and collision on your vehicle. So circling back to the teen driver, if you can find a reliable vehicle, obviously used, that you can pay cash for and know that, heaven forbid, there's an accident and they're at fault, that you're having to replace that vehicle, you can really cut your insurance premium in half because you're paying for the liability component, but not the comp and collision.
Because the car is really not worth.
Correct. It doesn't justify because
Yeah.
the comp and collision cost for a youthful driver is obviously significantly more expensive than it would be for someone that's not. The most important thing, though, is in the insurance world, I talk about big problems and little problems. With a youthful driver, you now have someone inexperienced and young driving on behalf of your family's assets. And so you don't want to sacrifice your liability limits so that they can get a more expensive
So let's be clear, you guys. Think of it this way. You are allowing your 16, 17, 18-year-old to drive around with your entire retirement account and bank account sitting in the back seat, cash money, gold coins, I don't care, whatever it is. In addition to that, it has your paycheck and future paychecks until it's all paid off. And that teenager is driving around Santa Clarita, the Antelope Valley, wherever they're going, and they're doing it solely with the experience of 18 minutes behind the wheel.
Yep.
And the radio is blasting, and their cell phone is texting left and right. Do you not think it's wise to, one, have a conversation with them, but more importantly, to make sure that you are insured properly? Look, John, a lot of people, I know that we've spoken about your phone number one more time, but can you give it out for me? Key Partners Insurance Services and John Gonzalez. What's your number?
It's 661-235-5885.
Guys, look, I like this because, look, Total Financial Solutions is about strategy. That's why Jeff and I have been around for a very long time. This is our 20th year. It's all about putting pieces together. I've been licensed in property and casualty probably 18 years, maybe, something like that. Shortly after, licensed to do financial stuff as well. And the purpose of all of that was so that we can talk, consult, and even offer these products at one point. Today, we partner with people like John who sit down, understand the strategy of making sure that our end goal is to make sure you can retire safely, because that's more important, live the life you want to live without being overburdened with insurance payments coming and going left and right on everything under the sun, and yet still be properly protected so you're not going to be forced to work for the next 20, 30 years to pay off a judgment where one of your minor children made a big mistake and now you're stuck, paying that back. John, if that teenage driver, or let's say they're now 18, 19 years old, but they're driving a car that's registered to me.
Correct.
What is my responsibility and liability insurance-wise with that?
Well, if they're 18, 19 years old and the vehicle's registered to you, in the event of a loss, especially a large loss, the other party's attorney will very quickly see that vehicle's registered to you, and then again, it's back to your assets that they're aiming for rather than the 18-year-old. So another way that we talk with people about trying to eliminate some of that exposure is going back to the scenario I gave you. You buy a vehicle that you pay for cash, and you can afford to go liability only on it due to the value of the vehicle. And again, you want something reliable and you want your child to be safe. Everybody wants that.
Sure.
I totally understand that. But when they turn 18, if you can then transfer the ownership of that vehicle to your now adult child, that really goes a long way in mitigating your family's exposure in terms of their liability.
Especially if it's an older car, Suburban or something like that.
And the key to that is
right.
It has to be paid off. It's very difficult. I don't know that it's possible to.
It is not.
Right. Go lease a Honda Accord and then switch that over into someone else's name. So that's really why, from a purely financial standpoint, if you're looking to protect your family in the best way possible with a youthful driver, that's the recommendation I make. It's a very hard one to follow. I understand that.
Because you're giving them that asset. It's now officially theirs. They can sell it tomorrow. They can,
correct.
Barter it or whatever they want to do.
But it takes away the exposure. And,
I agree.
And the difficult thing, too, it's, people... Again,
what happens to the insurance premiums, though, if it leaves the family and now goes to the minor or to the 20-year-old or whatever?
It would increase because you would lose some of... Depending on the carrier, some carriers... So insurance is all about discounts, meaning the carrier files a rate with the California Department of Insurance, and then they have all these different discounts that they can apply to get to what that actual rate is on the policy. So depending on the carrier, sometimes those discounts will stay intact, sometimes they will become disconnected, but at the end of the day, the financial impact of that price change is far less than continuing to have assets at risk with a youthful driver, because even at 18, 19 years old.
So, John, now you have, let's switch gears a second.
Sure.
Now you have a lot of the parking lots have these poles. Some of them are yellow, some of them are no colors, clear or whatever. And in doing that, you have, sometimes they use it to run chains across, no parking here, or we're going to close the parking lot, or we're going to, right. Somebody drives and hits that pole. It's poles on private property. Whose responsibility is that?
To repair the pole?
Yeah. Or the car. Like, is it the driver's fault?
So if you're driving a vehicle and you hit a pole,
Yep.
it's considered an at-fault accident. So you would want to, the damage would be to your own vehicle.
Probably,
so
yeah.
You'd want to have that repaired.
So now the pole is damaged.
It's broken. It's
Yeah.
on the floor.
Yeah.
So your property damage limit would pay for that pole. Property damage is things you hit. So vehicles, fire hydrants, poles. I think a vehicle drove into one of these buildings here not too long ago, a few years back.
Yeah.
So anything that you could hit with your vehicle would be covered under that property damage limit.
So think of it this way, guys. You're driving and you make a mistake and you hit something. There's a purpose to replace that. It's your fault. It's whoever's moving.
Correct.
Generally speaking,
Generally,
right?
yeah.
And one of the things that we talked about at one point is, at least you hear this, oh, I rear-ended somebody, so it must be my fault. I know you're not an attorney speaking at fault accidents, but from the insurance company's point of view, if you rear-end somebody or you hit somebody and it's the front portion of your car, are you guys always considering that the driver's fault? I mean, what if somebody pulls out in front of you or, that kind of thing?
So in the rear end situation, there's been very few claims where I have seen that to be either what they would call not at fault or a 50-50 situation where each party would cure their own damages. In terms of pulling out in front of somebody, generally the party that has the right of way is going to be found fault-free in that situation. So if you're driving straight and someone pulls out in front of you, they've impeded your right of way. If you're driving straight and someone makes a left turn in front of you, they've impeded your right of way.
So even if the damage is to the front of your car, guys, there's still other circumstances at play here. And that's what I want to really bring to you. I don't want you to immediately start saying, oh, it must be my fault. And look, as a former policeman, I can tell you, as a retired LAPD officer, I spent many regretful times taking accident reports. We didn't like it. There were traffic accident guys, and they loved it. That's what they did. They were traffic officers. There were street fighter guys like me, or what we wanted to be anyway, in our own minds, right? We were catching bad guys, and to stop and take a report and have to draw diagrams, we didn't like that a lot. It wasn't our favorite thing to do. But I can tell you that one of the things I want to encourage you to do is to not admit fault.
Correct.
To the police officer or the other driver. It is not your job. Your job is not to come out and try to explain, but I can tell you, I promise, what really happened was nobody cares. At that moment in time, are you okay, or do you need a doctor or ambulance? Number one. Oh, you're sore, but nobody's bleeding. There's no broken bones. Okay, then you get out of the way. You don't leave your cars. I can't tell you how many times driving on Soledad and Bouquet and McBean, where if it's just a bump, or the guy hit you, or he pulled out, or you didn't see him, I get it. Then nobody's hurt. Get out of the way. Pull to the side. Don't stop rush hour traffic. You're not there. They're not going to send a full investigative team like CSI and rope it off and shut down traffic and bring in, laser measurements. No, folks. You hit somebody. It's a car. You're going to fix it. It's pretty simple. Your statements, the witness statements, the other guy's statements, and then they'll figure it out. So this isn't their first rodeo. So you get out of the way. Pull to a safe place. Maybe a parking lot. Maybe off to the shoulder, right? Get out of the way. But I have seen 2 accidents in the last 10 days where pedestrians were hit. One on Lyons Avenue and then one...
Yesterday.
Yesterday, that's right. I was right there.
By the mall, Old Orchard, I believe.
Yeah, Old Orchard and Lyons...
Yeah.
Old Orchard and McBean.
Yeah.
Yep.
I read about it.
Yeah, big deal, guys. By chance, I happened to be there. I was on the one at Lyons and Old Orchard, and that kid, I think, was running out of OLPH. Or he was walking, I'm assuming he came out of the school that was right there. and I think it was his head that busted the windshield because there's a big crack in the windshield.
Oh my gosh.
So in that case, what do? You stop your car, and tough luck with traffic. You stop your car, you get out. First, you call 911 right away. You get an ambulance rolling. You make sure there aren't any other cars that are going to hit him or you or anybody else. And you make sure the person doesn't move, and you just wait for assistance to arrive. Okay, you don't get them up. You don't walk them around. You don't have them do high fives. None of that, folks. They sit there and they just wait and let the professionals come. So in that case, you leave your car there, right? Now, you might go, gosh, Arif, you're spending a lot of time on this. How many of you have sat there and you had two people sit there and they're yelling about a fender bender and you can barely see any any damage,
Yep.
and there's a 1.5 mile backup, and you're like, folks, really? I don't care if this happens on the freeway. You pulled to the shoulder. Yeah, you were looking down, he was looking up, you bumped into him in the fast lane. Good. Get out of the way. All right? Very important stuff. We're going to take a break. We'll be back in just a minute. John Gonzalez, Key Partners Insurance Services. I'm Arif Halaby. That's Jeff Gerard. We're here with special guest, your property and casualty. Specifically today, we're talking about auto insurance. You have any questions? Send them to us at 298-5487. That's 298-5487. I'm Arif Halaby, Total Financial Solutions, Safer Money Hour. We'll be right back. Welcome back to the show, Total Financial Solutions. Did you hear that? Total Financial. This is live radio. You can't. And take two. Total Financial Solutions. I'm Arif Halaby, along with Jeff Gerard. Your Safer Money Hour. How to keep yourself protected? How do you keep yourself from saving up your money, building up a lifestyle that you're used to, a lifetime of savings, and have an event come along and take your feet out from under you. A lot of you are familiar with car accidents that have occurred. My goodness, if you were here in the '94 earthquake and happened to have one incident, if you will, and you were not insured, you walked away from a cement slab and are still making a house payment on something that's not there. Those are pretty scary times. Earthquake insurance is pretty key to keeping yourself protected.
John, I've seen a lot of folks think that they have something, like we talked about earlier in the show. They think they have something that they don't. A homeowner's insurance policy does not inherently cover certain perils, right? Earthquake is one of them.
Earthquake is definitely one of them.
Okay.
Homeowner's policy will provide no coverage for the cause of loss of earthquake.
So it's a different policy altogether.
Totally separate. I mean, a handful of carriers will make it via endorsement, which is just an addition to the policy, but 90% of the time it's a totally separate policy.
And it costs more money. It's not how it used to be.
It's not inexpensive. Deductibles are higher, but in Southern California, while we do have wildfires, I still believe that earthquake is our biggest exposure is homeowners.
And so if someone has a place, is a normal homeowner's policy covered wildfires?
Yes. So fire, I mean, traditionally in the past, they were called fire insurance policies. But
Right.
a normal, what we would consider a homeowner's policy would cover fire, but it would not cover earthquake.
So a deductible is the amount that you have to pay before the insurance company starts writing a check.
Correct.
So it's the first few dollars. If you remember your health insurance, right, some of the conversations about that, there were deductibles involved as well. I think our deductible went from $3,000 as a family and $800 a month to $2,100 a month and $12,000 is the new. And we just got some great news. It's going up again. Isn't that exciting? It's going to be
I just heard that. I heard that today.
$2,800 a month. Well, the good news is you actually have to earn about $35,000 or $4,000 a month, pay your taxes. Then what's left, you have to pay $2,800.
Correct.
Isn't that exciting? For a whole $12,000 deductible, which means we'll see you sometime in June before the insurance starts kicking in.
Sheesh.
Correct.
Love it. Affordable care.
John, speaking of deductibles, I think that's one of the reasons why people kind of shy away from earthquake policies. They just take they just kind of roll the dice.
So where you're going with that, and a typical homeowner's policy deductible, $500, $1,000, $2,500, fixed number. Earthquake, a percentage from normally 15%.
Wow, is it that high?
It is that
I thought
high.
it was 10%.
There's 10% option. So we have a carrier that will go from all the way up as high as 25%, all the way down to 2.5%. So obviously, the lower the deductible, the more expensive the policy, but at least you can have several choices there to get that deductible. So if it's a $500,000 house and your deductible is 2.5%, that's $12,500. That's pretty good.
More doable than 50,
versus,
60, 100.
50, 75,000. And so that is one of the financial things to consider in earthquake is the deductible is obviously a large amount to stomach, but again, it's only structured that way because, like I said, I feel like it's our biggest exposure here. It's at some point, it's been 22 years, and knock on wood that it's been that long, but it's a big exposure, and it's not something that I want to say that I've read the national or the average is that 19% of homeowners carry earthquake insurance. So that's
Wow.
a big number that don't.
A lot of people are counting on the SBA to come along.
Or FEMA.
Or FEMA, and either give them money or give them a low interest loan.
Correct.
So they can do a 25% deductible, knowing that the amount that they're going to have to write a check for is going to be much lower because everybody else will come to their aid. But guys, here's some good news, bad news. The good news is you're now aware that the bad news is we do not have any money. We are at $20 trillion in debt. Okay, let me explain something to you. In the last 8 years, we have had more debt accumulated by this nation than from the beginning of us as a nation, right? You take from George Washington to George Bush, and you add up all of that debt. Add it all up. And we have spent more money in the last 8 years than all of that combined. You can argue all sorts of reasons why and who to blame. I get it. Who cares? You still have to pay for it. So if you think if there's another Katrina or Andrew or Northridge earthquake or Hurricane Sandy, if you think that the government's just going to come in and start writing checks willy-nilly like they did at one point, maybe there just isn't any money. So they just have to make it up. Next week's show we're going to talk about some of the issues that are happening in the pension system. I think you're going to be shocked to realize that the city of Fresno is the only entity in the entire state of California that has a functioning, what's called fully funded pension system.
Oh my goodness.
Wow.
The city of Fresno. Isn't that incredible? Not the county. The county's upside down, but the city has a $300 million surplus.
Really?
So that means they were fair when they negotiated with the workers. They were fair when they negotiated with the city. They were fair when they negotiated with the taxpayers, because everybody's kind of in the middle, right? It's not, nobody gets to win big like in some cities where the taxpayers are going to have to pay the bill. And eventually taxpayers revolt. So there's a huge debt issue, whether it be pensions, whether it be the normal debt, just in the United States alone. Here, these are good numbers for you. In the United States alone, we have $6.5 trillion in money that's circulated. Okay, 6.5 trillion. That's a lot of money.
Yeah.
But how much in debt do you think we have across the board? We have, oh, sorry, my bad. Let me make it clear. $3.8 trillion in circulation. 3.8. 63 trillion in combined public and private debt. I want to get you the exact number. Do you understand? That means of all the money that's possible, there's only 6.3 trillion. And there's 3.8 trillion. I keep messing that up. 3.8 trillion. And there's 63 in debt, public and private. So if you think that you're going to not have earthquake insurance and don't worry because the government's going to come in and help you, then why just go on welfare now and start now? I mean, there's no reason to. If you're going to
you have a better chance of qualifying if you more time under your belt.
Man.
Yeah,
just be that guy who exists. Plays video games and sends out 47 resumes and call it "I'm looking for a job." How about you just figure out that it's up to you, right? If your arms still work, your legs still work, and look, I have seen people that have some of that not work and still go out and work hard every day.
Yeah.
So I go down that road because I think you understand it is your obligation as a citizen to have the proper insurance, or just have a house that's paid off and say, tough luck, I'm taking the risk. People do that. They pay off their house and they cancel their earthquake insurance. They said, look, if it goes under, I'm going to replace it. I'll just go get a loan, and because I owe nothing anyway.
There's always options.
Yeah, you can do those things. But don't think that the government or your fellow citizens or the guy who happens to have some sort of financial success, or the gal that works hard and 2 or 3 jobs is the one that's going to bail you out. I think it's up to you, really. Additionally, remember, folks, earthquake insurance, fire insurance, you don't have to replace the land. So your home, you might have purchased it for $650,000, but it's not $650,000 worth of insurance that you may need. because the land is still going to be there even in a fire or a flood or an earthquake. It's the structure you have to replace. So there's a percentage of that $650,000, maybe 70% or 80%, whatever the number is. That's what you have to insure. So it's going to be a little less than you might think.
Correct.
People
100%.
forget that, right?
Yeah. It's all about the cost to rebuild the structure. That's what the insurance carrier and us were concerned with.
What about on the earthquake side? There is a component that for changes, like laws that have changed, upgrade.
So that's called ordinance coverage. So if you have a house built in 1970, the policy is designed to rebuild that home to 1970 code. Ordinance or code upgrade, commonly called code upgrade, is a limit that's in the policy that will pay for changes in code from 1970 to 2016 when the loss occurs to get a new 2,000 square foot house, 3,000 square foot house built to 2016 code.
Yeah.
The other thing is loss of use. If your house is red flagged and you can't live in it for 6 months, the mortgage company still wants to get paid.
Sure.
Right.
You still need to live somewhere. So say you have $100,000 in loss of use coverage, that will pay for you to live somewhere else and any additional expense associated with that while your home is being repaired or rebuilt.
We had clients in the 94 earthquake all throughout Granada Hills. And I wasn't in business at that time. I didn't start until June of 96. But they were clients that went through this and later communicated this story to me. And what they would do is they would have an RV parked in front of their house. They'd run an extension cord because electricity was stabilized. Sometimes they would run a hose. And they would use their loss of use coverage to pay for a brand new RV. And because they waived the ordinance in the city of LA for a period of time, and probably Santa Clarita, that allowed you to still have an RV on residential streets or in the driveway. So they were able at the end, instead of having a bunch of receipts that said you stayed at the Hyatt or Best Western or wherever you stayed, instead it says you own a brand new RV.
Interesting. Now, I wasn't in the business in 94 either, but I haven't heard that story. That's awesome.
All over. And I was a policeman in 94, actually in Northridge at the time. And so I saw that happening. I didn't understand it because I wasn't in the financial business at the time.
Interesting.
And so they used the funds. They ended up with an RV at the end of the day and paid the payment, double paid or whatever it was, up to their limit each and every month. Were able to watch the home be rebuilt or remodeled or whatever it was to be repaired.
Interesting.
And at the end, had a nice RV.
Had an
Certainly
RV.
was well used with
right, for the rebuild period, however long that was.
Yeah,
that's
family
that's
living there.
interesting.
And not a lot of miles on it probably to go dump some of the tanks and then return.
Yeah.
But folks, John Gonzalez, a wealth of information. John, we're going to ask you if we can kind of tap into you over the course of the next few months and years
Please,
to go.
yeah,
if we have
absolutely.
folks that have questions, maybe have you pop in every once in a while if there's a topical issue. And
I would really appreciate that. That would be great.